What I'd like to do is I'd like to introduce our primary speaker today. And I'd like to thank COPEC, which is, let me make sure I get it done properly, the Central Ohio Professional Education Council. And they are the organization that is with us today making the presentation. We have Mr. Jay Lindner, who is our main speaker here to my left. We have Mr. Jerry Snyder, who's in the audience waiting for his cue. And then we have the wonderful assistance that's being provided by Nate Quilter, Hannah Jacobs, and Jay Griffiths. So thank you very much to COPEC for coming out. We'll do that in advance. This is a great opportunity for us to learn and to become prepared, because one of the things that we work for is that day when we can be retired and we can pursue other dreams and other activities. And so part of being able to do that successfully is preparing. And one of the main ways that we need to prepare, of course, is financially. So we've been very pleased to be able to bring to you all a nice grouping of presenters and topics that can help you for that day when you eventually get to pursue all those other dreams. So without further ado, thank you.
Thank you very much. Can everybody hear me okay? Awesome, thank you. First of all, on time, I will be speaking quickly because we have a lot to cover, and we're going to try to leave 10 to 15 minutes at the end so that we can ask some of those questions. And I know that we have to stop after an hour, but we will stick around for any questions you have as well. So please know that. So during the program, probably won't have too much interaction, but we'll keep things moving for you. A couple things. Everybody got a handout? If you do not, just raise your hand and Nate in the back can make sure you get one. So he'll walk around, grab one. Also, it says ready for retirement, that form. That's just for you to walk through. You don't have to turn it in. You don't have to do anything. But it's about 12 questions that we like to share for you to be able to go through and answer. And if you answer them no, then you might want to look into those areas that it's just an awareness. So use that as a tool for you to kind of poke into the areas that you need to focus on. On the evaluation form, several things. One is let us know how we do. We're not professional speakers, but we try to do our best. So feel free to give us some advice, speak up, whatever it might be. We're happy to take that. Also, if you have any areas that you want additional information, we'll send you that at no cost. If you need any assistance one-on-one, just share that with you. We're not here to push anything or sell anything, but we're here to help you get through those areas of education and clarity in your own retirement transition. So that's what the forms are there for. And the evaluation form, just either leave that on a seat or turn it in at the back at the end of the day. And as she mentioned, I am a certified financial planner. We have an office in Dublin, and been doing this about 27 years. And so we feel that through our experience, we can bring our industry knowledge to you and hopefully give you some things to think about. So as far as what we're going to get into today, make sure I'm doing this right here. There we go. There's the evaluation forms. There we go. So I'm really hoping we can get through this in about 35 minutes. So we're going to have to move pretty quickly. But the first thing is, anybody want to throw out what's the number one thing you need to do in preparing for retirement? Who said that? You win the prize of the day. You got a plan. You have to understand, receive clarity, set your goals, plan it out before you deal with any of the other areas, whether it's income or expenses or investments, things like that. So a lot of people don't plan properly. So we're going to put a little bit of focus on that today. Expenses, in my opinion, through the years that we've been doing this, the two biggest reasons why people, and we'll talk a little bit more, don't do a proper full retirement plan throughout retirement. One, they don't stay on top of what their true expenses are. So we'll go into that a little bit. Anybody want to take a gander or a guess as to what the other big problem that people don't predict well enough? That is definitely a good one. The biggest one that I feel people definitely have oversight or miss is the impact of inflation. How many people have sat there and go, I remember when I bought my first car, it cost this much. Right? We can always go backwards because we have a point of reference. But if you go back 30 years and you think about what your first car cost, how many people go forward 30 years and go, I wonder how much my next car will cost in 30 years? People don't do that. And so it's a challenge for people to put that into place. So we'll get into that. Retirement income review, Social Security income, and we're going to kind of gloss over that pretty quick since you've had such a great presentation on that, so we won't dig into that too much. And then review a couple things on healthcare and estate planning. One of the big issues that we deal with is we are living longer, right? How many people have parents that are in their 90s? Raise your hand. Wow. 95. One, two, how about 100? Wow, that is so neat. But the challenge that we have is the longer we live, the more that we have a concern of making sure our assets live as long as we do, right? So that's a big area that we really want to focus on. 1 out of every 4 retirees will live past 90, and 1 out of 10 will live past 95. So these are things that we want to be very concerned about to make sure that we're assessing our finances to live as long as we do. Do you know where you stand financially for retirement? Clarity. What's the first thing a GPS does when you say, navigate to the DLA defense, if I'm over in Dublin or whatever? What's the first thing the GPS does? Where are you? It can't tell you where to go if we don't know where you are. So the first thing we need to do is make sure we have a full understanding of where you are, what your expenses are, what your income is, all of these things. So that clarity is real important. And then the problem is, how many people went on vacation this year? How many people spent at least 2 hours planning that vacation, sitting on hold with the airlines, whatever it might be? All right? Now, how many people at least spent 1 hour this summer focusing on what their retirement will look like? If I came back, that better be everybody, because that's what we're trying to do here, right? So when we deal with what your retirement looks like, how many people think that their retirement is sitting at home and putting a TV dinner in the microwave or eating ramen noodles or just surviving? That's not what we want. We want to go travel. We want to be able to go out to dinner or see our grandkids or buy, right? We want to do those things. So we really like people. Our industry does this. We break up your retirement into 3 major categories. What do you need to retire? What do you want your retirement to look like? And if you can, what is your wishes? Well, a wish might be, I'd love to go traveling Europe every year for a month at a time. That's a wish. You can live without that. But a want is, I'd like to at least go to Europe for a week once every 3 years. And a need is clothing, shelter, food, transport, right? So we need to make sure that we understand what kind of retirement we want it to look like and plan accordingly. So financial independence, has anybody heard of financial independence versus retirement? Anybody want to take a stab as to what the difference is? Financial independence is the fact that at a certain point you are independent from having to work. You have enough assets and income to be able to sustain you the rest of your life. Retirement is the act of stop working. Don't confuse the two. A lot of times we get people that say, I got my 30 years in and I'm going to retire. Okay, that sounds great because your benefit says you are at full retirement age at 55 or whatever it is, but are you financially independent? That's completely different. And I always joke around, wouldn't it be nice to be 58, to be financially independent and now be able to go into work every day and know that, if that boss really gets on your nerves too much, right? You've got the ability to do what you want to do versus what you have to do, which is work every day. So that financial independence brings that independence for you to do what you want versus what you have to. Some key issues. First of all, track if you're on track financially for retirement. Financial independence projections has a lot to do with how you should invest your retirement money. It gives you a lot of perspective as to how those allocations should be set up, what the risk tolerances is, what you can sustain, and what you can withstand, depending on your risk tolerance. So model pension payments. Do I take the joint life, single life, period certain, things like that? Model Social Security, long-term health care. How you deal with income taxes is a big deal. And then Monte Carlo. What that is with financial independence, a lot of times people do a straight line where it's like, let's assume you get a 6% rate of return every year based on historical numbers. We all know the future is not going to be 6% every year. It might average 6%, but it also might average 2%. Maybe it gets 10%. Who knows what the future holds? So the Monte Carlo is a program that actually allows you to test your future economic climates a lot of different ways based on your financial plan. So it's really critical to make sure that you address those things. Important planning variables. What is your projected life expectancy? If you have parents that are turning 90 and you're in very good health and we have modern medical science that's getting better, should you at least project out to 95 maybe? So we usually default to 90 as a starting point. We had one gal, she's in health and wellness, and her mother passed away at 101. So she says she has to do 102. So that's the farthest that I really pushed it. But impact of inflation, the financial assets, risk tolerance, allocation, standard of living, your expected rate of return, Social Security income, pension, inheritances. We're always really kind of hesitant projecting inheritances because you never know how those things settle out. But healthcare and long-term care costs and gifting strategies. There's a lot of variables that we can plug in there. And what these are great little pictures to give you a feel as to what. There's been a commercial, I can't remember which company it was, but the people are walking around with this big number under their arm. Has anybody seen those commercials? And the question is, what is your number? Well, you could argue it's kind of like your cholesterol number or something like that as far as how do you evaluate if you're fine. But the first thing I'll say is, if you have a lot of pension income and Social Security income, do you need anything saved in your thrift savings plan? Maybe, maybe not. If your pensions are $100,000, but your expenses are only $60,000, maybe you don't need any savings. So whenever somebody asks me the question, what's a good number? If I'm going to retire, should I have like $1 million? Should I have $5 million? I don't know. I don't know the answer to that because I don't know your situation. But what this does is we take into account, let's say this person here is 50. What this number here represents is the amount of money, and I'll talk to you a little bit later about the gap that we're solving for. That's your investments, not your pension, guaranteed income, not your Social Security, but the amount of investments that you need to supplement your guaranteed income. Over time, it is going to rise to the point that you want to retire. Then you obviously stop working and start using your income and your investments, and eventually those assets deplete at some point. My hope is you die here, not here. Right? What's that joke? You know, well, I'm going to have my last check that I write bounce to the funeral director. Yeah. One of our speakers is Mike Schettinger, so I like throwing him under the bus on that one. But I don't know if we want to call it that close, quite honestly. So that's a basic picture, and let me go back real quick here. So we don't know what the variables in the future hold, but let's say that this is 90 and we have the money just go out to 90. Well, what if inflation was a little bit higher than we projected? Boop, it fell, right? What if you had a long-term care situation? Boop, it fell. We want to do everything we can to make sure that we don't have these variables be different than what we project, because they're projections. We don't know for sure. So this is way too close for us to feel confident. Now, if, just like medical, if you know earlier that you have high PSAs or you know you got high cholesterol, right? If you get a sign early on that you have some physical health problem, doesn't your chance of success of beating it dramatically grow the earlier you find out? Well, the same thing is here. If I find out that my assets and income only last to age 78, not to 90, wouldn't I like to know when I'm 50? How many people would prefer to find out the day after they retired from here that, oops? I mean, we talk about retirement being an irrevocable decision. How you choose your pension is an irrevocable decision. But for most people, if you retire, and I hate to say under false pretense, but you're not clear as to what your plan is and what your future projections are, and you find out 6 months later, and you go back to your HR department and go, hey, by the way, I brought you a little gift. You always got to sweeten them up first. Can I get my old job back at the same pay because I kind of made a mistake and I retired too soon, right? Chances are it's not going to go so well. So we need to make sure that we see that picture as soon as possible, because maybe to fix this, maybe we need to save $500 more a month. Maybe we need to reevaluate what our needs, wants, wishes are in retirement. Maybe we need to push out this retirement a couple years. Maybe we need to pick up a part-time job doing some part-time supplemental income while we can work. And typically, where I really deal with this even more than most is people that are trying to aggressively retire early. I really want to retire at 55. Well, great, let's attack it. Worst case scenario is if it doesn't work, you retire at 58, 57, 60. But those are some things we can attack. And then this is a picture that is what we're really shooting for. And it doesn't matter if it goes straight up, but we want it to be higher so that you feel confident that those dollars are going to be there even if you live to 100. So we don't want to call it too close, but knowing your picture and being able to fix it when you can is really critical. Most retirement plans that fail do so because they don't stick to their planned budget. I am the biggest victim of this. I don't like budgets. If I want to go buy something, I want to buy it. And guess what? While you're working, you can get away with it. You can always put in overtime, right? There's always extra money coming in. When you're in retirement, your pot of money is pretty well stagnant now. And how we protect that and make sure that we stick to that budget that we predicted is critical. So failure to stick to this projected standard of living. Good example of this, we had a client call up one time and he goes, yeah, how does our plan look if we had an extra $600 a month bill? We're like, Joe, where are you? Well, I'm sitting in the Corvette dealership. We're like, all right, well, where's Linda? You don't understand, she's in the car, I can't get her out of it. So $600 a month, how does it affect my plan? Because I want to change my standard of living for whatever it is, but I want to see the ramification. We went through it, we looked at it, and it didn't hurt as bad, and he made the choice, it's worthwhile. There isn't a yes, no, you can and can't. It's a, what does it do to my plan if I do this, that, or the other? That's all it is. Underestimating inflation, have excess one-time withdrawals, and this one really ties in closely to this one here. Family members. I'm not saying don't help family members. Absolutely help family members. But a plan doesn't care how righteous your withdrawals are, right? If you take out $10,000 to help a family member, it's $10,000. And sometimes we actually have to have very serious conversations with our clients that you're taking those later years and you're spending that money today, as important as it is, you need to just understand that it's having an impact. And so sometimes that's a really hard discussion because it's not don't do it. It's just understand the ramifications of what's happening with those extra withdrawals, whether it's family, whether it's a Corvette or whatever it might be. Poor tax bracket management on investment distribution. What happens when you're 59 and a half and you take out money before that date? You get a penalty, right? 10%, that's pretty big. First of all, if you don't take your required minimum distributions at 70 and a half, does anybody have an idea of what the penalty is there? It's a 50% penalty if you don't do that right. So make sure you pay attention to those RMD calculations at 70 and a half. But at 58 and a half, if you take out money improperly before 58 and a half from your retirement accounts, it's a 10% penalty. If you don't manage your tax bracket correctly and you take out too much money at a higher bracket, when if you would have waited a year, it might have been at a lower bracket, that very easily could be a 10% penalty just because you didn't manage those withdrawals correctly. So be very careful when you take money out that you're taking advantage of those lower brackets when you can. So we had one person, he was retiring in a year, but he really had to get that trailer for retirement while he was working. And I kept asking him just to not. Take it out of an equity line, get a loan, do whatever you need to do. Don't take the money out until next year because his bracket went down once he retired. So just be patient. Or borrow it and pay it off when you retire. I mean, just simple things like that. And failure to account for the extra health and long-term care expenses. We don't care if you go, plan for Medicaid, private insurance, private pay, it doesn't matter, but just be aware of what those options have on your plan. And then, as far as the expenses, I talked a little bit about this, needs, wants, wishes, fixed versus variable, inflation, paying off a mortgage. My belief is paying off a mortgage, if you have a good interest rate on your loan, and you have a decent rate of return, a higher rate of return on your investments, well, then you have to think very carefully as to whether you should pull out from your investments to pay off a mortgage because you're taking a higher returning earnings and paying off a lower return. That's the financial side of it. The argument, though, is if you can't sleep at night, pay it off, right? The comfort level takes precedent over financial. I'm a big believer that if you're typically at least 50% or more of equity in your home, then you're okay going into retirement because now it's just an expense. You're not going to lose your home, right? So that's a personal preference. I'm not saying do one way or the other, but just assess it. With expenses, I'm a big believer. I actually, like I said, I don't budget, but I track my expenses every month. There's a lot of tools. You can use spreadsheets. I actually use spreadsheets a lot for myself. I just did it for 20 years, and so I still do it the same way. There's credit card tracking tools. There's retirement plan tools. I'm sure you may have something through your bank or maybe through your TSP maybe. Account aggregation and spending tools. Then we actually, like when we work with our clients, we actually do annual validation. If our plan says that with your expenses that you're probably going to have $8,000 left over in your bank account, well then a year later, did the bank account grow by $8,000? And if it didn't, why? Oh, that's right, I gave that money, or we had a wedding, or whatever it was. Okay, it's explained. That way we can validate those expenses all the way through retirement. So it's real important to do those things. And I like to talk about this three-bucket approach, and I'll do this very quickly, but the three-bucket management, this is one of the tools that can be used for spending and budgeting. But this is really nice here. I do this, I've done it for years, because it helps me force myself to be aware all the time of what's being spent. This is just an example of income. And don't worry about the numbers here, but all of my money goes into one bucket. All of my income goes into one holding bucket. And then each month, because you have to do this in retirement, each month I'll pay myself in two completely separate accounts. One account is what are fixed expenses. Those are things like your mortgage, your car payment, maybe your utilities, things that, remember, needs versus wants versus wishes? This is what you need to pay every month. Now, you could argue that Corvette payment falls under here, right? Because it needs to get paid. But if you really are having trouble with your budget, you got to get rid of the Corvette to lower all of these, right? But these are things that are paid every month, and I track that every 15 days. So on the first of the month, I'll send over, in this example, I'll send over $3,000 because I have a budget of fixed expenses that I know takes up $3,000 or whatever the number is. And I check them off, right? Then I put the balance of what I expect to pay over here. This is where you do auto bill pays and all that stuff. Over here, this is my eating out, buying gifts, doing a small travel, whatever it is, that's on that side. I don't budget over here. I don't sit there and write down I bought a coffee at the gas station as I was checking out. But guess what? If I'm halfway through the month and I'm already 80% spent, I got a problem. So then, if you're having trouble getting a positive surplus, that's where you want to look. Maybe some big here, but you can be very clear on how your expenses are managing. And it's good for spouses as well, so that you guys can be on the same page. But that's a great way just to get active. It's just setting up 3 accounts and moving the money and watching it deplete over the month. And then as we get into retirement income, we've all seen the 3-legged stool concept, right? We have your Social Security, then you have, in your situation, the federal pension, and then you have your individual savings and investments. That would be your TSP, right? It'd be your TSP plus, IRAs and other investments that you may have. And so it's important that we look at all those different income sources. And then what we do is we take a look at what is your retirement expenses. And remember, it's retirement expenses, not what your expenses are today. Anybody have throw out some ideas of what expenses may go up in retirement? Taxes? Well, hopefully taxes will go down. Life insurance? Prescription drugs will go up. Health insurance costs, health care costs will probably go up. What else? Do you want to travel more, maybe? Maybe hobbies? That's the funny one, when we find out how much people's hobbies expense goes up because now they have time to do it. Also, how many people here have children? How many people here have grandchildren? And how many people thought their wallet wouldn't open up until they realized they got grandchildren? Right? You kick the kids out of the house, you're on your own, I helped you, take care of you, get you through school, whatever it is that you did, and you're thinking you're free and clear. You retire, all of a sudden, down the road, you get grandkids, and guess what? That wallet opens right back up again. So we need to predict in the future of the different types of expenses, because like I said before, it could be as worthy and noble, it doesn't matter. The plan doesn't care. When you run out of money, you run out of money, right? So we do our best. So expenses, what's the retirement income? Well, we're talking about 2 years out on retirement. If we're 2 years out on retirement, your retirement income is relatively predictable, isn't it? Right? Social Security, how many people are socialsecurity.gov, right? You have some great presentation. It's pretty predictable what your Social Security is going to be. It's pretty predictable what your pension is going to be. Maybe not which choice you take, but it's pretty predictable. What you don't know is, did you save enough investments to offset that shortfall? And this is a good visual of what we talk about. Let's just say that your expenses are $50,000. And your estimated annual income, let's just say from Social Security, is $20,000. Your shortfall is $30,000 in this example that you need to have saved up in IRAs or the thrift savings plan so you can meet the need of your $50,000 a year. Pretty simple, but sometimes it's hard to get these numbers to work and actually succeed the way you want them to. For your pension, and I'm going to keep scooting here, for pensions, defined benefit, defined contribution. Your defined benefit is your federal pension, correct? They define what your income's going to be. Versus a defined contribution, this is defining how much you can put in. This is your thrift savings plan. And each of them work a little differently. For your defined benefit, everybody has different options: single life option, joint life option, 100%, 50. This is general. This isn't for yours specifically, but your federal pension has different options. So you need to make sure you know what those options are and you apply those to your plan to make sure that you're picking the best one for you and your spouse, right? So it's real important to understand those options. This is an example. If you have a single life payment of $41.25, if you did a 50% survivor, that amount's going to go down, but at the death of the pension owner, the other spouse will get 50% of that $3,800. If it's 100%, it's going to go down by nearly $600 per month, but at the death of the pension owner, the spouse will still get the exact same amount. So you'll have to decide which of these types of options is right for you and your plan. For the retirement plans, the 403Bs, 401Ks, TSPs, 457s, these are all the investment accounts that we can get into. We'll answer questions on this. We're not going to get too much into the accounts with the 450 or the TSPs right now. One thing, though, I do want to talk about is this Roth IRA. Roth IRAs are awesome accounts that are available to everybody as long as, I think it's joint under $180,000 or something like that. And if you, and I'm talking outside of your company space, if you have money sitting aside in a bank account and you qualify, you can move $5,500 or $6,500 if you're over the age of 50 from your regular account to a Roth account, and it doesn't cost you anything. It could be left in a bank account. It could be left in a CD or investments or whatever. But what you've done is you've slowly moved a little bit every year into a tax-free account. So even if you still need it as an emergency fund or for college savings, the Roth IRA is phenomenal because you don't have to either or, whether you do the Roth or don't do the Roth. If it's eligible and you have the money, put it over there, because there's great unique benefits for withdrawals. If you put $6,500 in a Roth and it grows to $7,500, you can't touch the $1,000 of growth unless you're over the age of 59 and a half or for college, certain exclusions, without a penalty. But you can always touch the $6,500 because it's a return of your principal and you can do it at any time. So you don't lose the liquidity benefit that you want in your normal savings or emergency funds. So all I'm saying here is please take a look at those, because you can, if you don't use them, now in retirement, you've got a tax-free savings vehicle that's still growing. So it's a win-win, okay? So they're great tools to use. Social Security, I'm going to go through this very fast. Basically, full retirement age, 67, as early as 62 and as late as 70. The biggest thing, remember here, is that if you take it early as 62, your full retirement benefit amount should go down about 30%. Okay, make sure when you do the socialsecurity.gov or meet with the consultants when they come in, as far as evaluating. One of the things that I'm always concerned about is when people take their Social Security or the pension too soon because they don't want to work, but they didn't take into account what that means at the later years. Because it feels good, I started Social Security so I don't have to work, or maybe it's a supplement, I don't have to work as much or whatever, but they don't see that you're hurting yourself down the road because you've decreased that benefit and it doesn't grow with inflation really well. So we want to be really careful not to take it too soon and hurt what that income is. Everybody's seen, like in the political situation, they'll sit there and whoever is running for office. You know, I remember when George Bush did the prescription drug situation. I believe it was him. He basically said, I want to introduce, you know, everybody to Mary Jane, let's say. And Mary Jane is 93 years old, and everybody's like clapping. Oh, that's so nice, right? And then he says, Mary Jane is on a fixed income. What does he mean by that? He means that Mary Jane is receiving Social Security probably, and it's less than what she needs to survive, right? So usually that's what they reference when somebody's on a fixed income in a negative connotation. That fixed income is not enough to support their standard of living. So that's something that we want to be really, really careful with. As far as when your full retirement age, this chart kind of throws out that if you're born in these certain years, this is what your full retirement age should be. And my assumption is it'll probably keep going up at some point. Also, be very careful. If you take your Social Security before your full retirement age, and you work, you can lose your benefit up to 50% for every dollar you make over $17,000. So be really careful that if you take Social Security too soon, make sure it matches up with what your working intentions are. And then taxation of Social Security. In general, Social Security is not taxed unless you earn over certain thresholds. So if you're filing joint, 32 to 44,000, up to 50% of your Social Security can be taxed. And if you're over 44,000 filing jointly, then up to 85% can be taxed. So a lot of people sometimes manage their distributions to try to minimize the taxes on Social Security as well. Okay? Now, I'm going to turn this over to Jerry. He's going to talk a little bit about healthcare and some estate planning, and we'll try to wrap this up in about 10 minutes and then take as many questions as we can, okay?
Thank you, Jay. I feel like the game show. I'm coming out of door number 2 here or something, but it's nice to be with you. Jay mentioned a couple times healthcare, and I don't think I have to tell anybody in this room how important that's been becoming in our overall retirement planning. These can be subjects of a seminar unto themselves, so we'll just have to do a real high flyover. But real quick distinction, which I think you already know, is the difference between acute care and long-term care. And both are very important in the planning process. But acute care, of course, is your doctors, hospitals, outpatient services, lab fees, and things of that nature. Long-term care, of course, as many of you know, is a whole set of different services. And it may be private pay instead of having insurance pay for it. So it can be, of course, assisted living, skilled home care, definitely falls under long-term care, hopefully, because that's where most of us would like to get our care. So real quick review, because I think many of you are on top of this, but Medicare, or we call it original Medicare or traditional Medicare, covered the 2 programs, Medicare A and B, and of course they've added 2 other parts of Medicare, which we'll touch on, C and D. A, of course, again, is your hospitalization. There's some home care benefit under that, but there is also some recuperative care in a skilled nursing home, not to be confused with long-term care. And then Part B is kind of everything else, which is your outpatient, your surgery benefits, your lab fees, and those kind of things fall under B. Both A and B have deductibles to be aware of. And then, of course, Medicare A and B started in the mid-'60s, and then in the mid or early 2000s, they came out with Part C. And really what that amounted to was Medicare outsourcing another option to get what Medicare would normally provide in the way of health benefits. So they certified many insurance companies locally, the Med Mutuals, the Anthems, the Mount Carmel, and most of them got certified to provide the equivalent Medicare benefits under what we know as the Advantage programs. And then, of course, Part D came out relatively recently, which is your prescription drugs. So you have some very important choices coming up when it comes to that, when the time comes. As long as you're working, of course, most of you would be staying under the federal health plan. But there's some very important decisions as you decide to separate from service and you've become age 65 or older. And I think most of you will qualify automatically in one way or another for Medicare A, but the important decision you'll face is Medicare Part B. And I think many of you would not be required to join Part B. You can keep your federal and have that act for a lot of those services. But as you may know, once you would elect to defer or not go on B right away when you're first eligible, you actually could pay a penalty if you need to join that later in life. So it becomes a very difficult decision, but a very important one, which we recommend you take a lot of care over. When it comes to long-term care, just a few brief comments on that. Very important, it's a very individual decision, but why even consider it? Well, I think the obvious reasons, of course, is to protect the income and assets. You've worked so hard to accumulate that for so many years. And if you get into a long-term care, of course, you can be spending very significantly. We hear a lot from our clients, I don't want to be a burden to my children. That's an aspect of planning for long-term care in advance, so you don't leave those decisions to children or other family members. I think one thing that's become more and more important is independence, to pick the location that you choose for long-term care if you need that for yourself or a loved one. We're going to touch on Medicaid just very briefly, but Medicaid is our safety net in this country, funded in part by federal and part by state. And so that's our safety net, but then it gets into having to go to a location, oftentimes a skilled nursing home, so you lose choice as to where you might need to get that care. And then, of course, our other health insurances don't really cover long-term care. So again, I'm just listed real briefly. We don't have time to go. It's a subject unto itself, I think, is the long-term care planning. But when we go through the planning with a client, first thing we'll look at is, do they have an ability to self-fund, self-insure? We don't want clients spending money on insurance that they don't need. So that's the first starting point. And just as Jay went through those graphs of projecting out, we might stress test a financial plan. What if you would get into long-term care for 5 years? What is your ability to self-fund that? So we'll actually make those stress test projections in our planning. Again, Medicaid is the opposite of the self-funding, where you get in, you need long-term care, you haven't made other plans, you're spending down, depending on whether you're single or you have a spouse, would depend how much you have to spend down. A single person really has to spend everything on their own care before really Medicaid steps in. So, you know, that's an important aspect that typically we'd want to try to avoid. There are so many different locations and quality locations for care now. CCRCs, or continuing care facilities, we see more and more of those now. Can be a very nice option, where you have one campus, of course, you have independent living, assisted living, skilled nursing, even Alzheimer's kind of care under one campus, so you don't have to keep moving and make significant moves to get your level of care. Reverse mortgages have had a bad reputation, maybe a last resort type reputation. The federal government has moved in and has done a much better job of regulating those. And actually, we use a different terminology now. HECM is a type of mortgage where if you want to stay in your home particularly, but you have limited resources to have care come in, you can actually reverse and start using equity out of your home to pay for long-term care. So I think it's becoming maybe a more accepted option. And there's so many now life insurance products available for shifting the obligation onto an insurance company rather than out of your income and assets. And so there are a lot of insurance products to look at. Yes, they cost money. There are even, there's traditional where you kind of pay as you go, as you would your homeowners or automobile insurance. You pay it, you hope not to need it. But there are life insurance products and annuities now that are kind of interesting to look at as well, where, let's say, life insurance, if you need long-term care before you pass away, you can actually accelerate the death benefit to a certain degree, or maybe totally, for long-term care, which is maybe more important than the death benefit becomes. So these are all products that are available that might bear research and looking at as well. We did want to save some good time for questions. I want to wrap up to just put a little plug in for estate planning. While you're doing this retirement planning, while you're pulling all your information together, whether you're dealing with an advisor or not, we think it's an excellent time to also review your estate plan as well. Things change. When we're helping people settle estates, we run into all kinds of problems. Oh, I forgot to change the beneficiary. You know, I have my mother who's been deceased for 10 years as my primary life insurance beneficiary. So these kinds of things can really add a lot of time and expense for settling one's estate. So, you know, think about reviewing your will. Do I need a trust? Making sure your investments and assets are titled properly. You can do so much if your goal is to avoid probate, the time and expenses of probate. You can title just about every asset you have, and of course your beneficiary designations, to actually avoid probate on a very cost-effective basis. And of course, at the same time, we'd want you to review your health care directives. And then finally, I would conclude by saying one important document that we see missed a lot is your financial power of attorney. There's healthcare powers of attorney, there's financial powers of attorney. Financial is giving someone else the ability to act for you when you can't act for yourself to make important financial decisions. We see that overlooked a lot, so make sure that's in your portfolio of estate documents. Well, thank you so much for your attention. I know Jay appreciates it. And at this point, I guess we'd open it up for questions if
Well, first of all, thank both of you so very much for coming and sharing time with us. I know that some of us are on very limited lunch time, so I know some of you have to depart now. But for those of you that are able to stay with us, please let us know. We'll take any questions now if you have individual questions. Our guests would be glad to answer them. Questions? I have one. So if I decide that I want to have a financial power of attorney, how do I ensure that that financial power of attorney is not used before I want it to be used?
That is a great question, and there actually are different kinds of financial powers. And that is a good point, and I'm glad for the question, because if you exercise what we call a durable financial power, and by the way, you need to execute that while you're still in sound mind. No competent attorney will allow you to execute that unless you can prove competency. But the durable power says that when you execute that, you are actually giving the person that you name, you're giving them the authority right away to act in your behalf. Now, generally, you're still capable of doing that for yourself, so you want to pick a trusted person that's not going to abuse that power.
Where were you before?
But technically, they actually can use that power immediately, and you're just under an agreement that they would not do that until there is a need.
Oh, you were a couple of you.
So if, in fact, there is a concern about giving somebody the power too prematurely, then you can do what's called a springing power of attorney. Like the name implies, when you execute that, the power doesn't shift to this other person until a future event. And that future event usually is the approval or the certification from two additional people, normally doctors or surgeons, that will say, okay, now it's time. The individual that gave that power is not really capable of making wise decisions. So we certify that the power can be shifted. So many, and I would say most of us, feel comfortable because we're naming a very competent person to assume that power that would not take advantage of us. But in the case of concern you could look into that springing power.
So then I'm going to ask the same question about titling of assets. If I decide that I want to do a titling of assets, is that, whatever the asset is, does it become joint, or does it go solely in the other individual's name?
Again, great questions, and it's something to be very, very cautious about. And that does depend on really the precise wording of that titling. So I'll give you two examples either way. If you have a house, a primary residence, and whether it's with, you have a spouse or let's say a daughter, and you're going to put that in their name jointly. And so if it is just jointly, you have really, when you set that up, made a gift, actually. You probably don't